Hello, I am Matthew. Have you ever heard of the term short selling? It's a strategy used by traders in the stock market to profit from a falling stock price. In this video, we will explain what short selling is, how it works, and the risks and benefits associated with it. Short selling is a way of making money from a falling stock price. It involves borrowing shares from someone else and selling them in the market with the hope of buying them back at a lower price later. The trader then returns the shares to the original owner and keeps the profit made from the difference in price. Let's say you believe that Company X is overvalued and that its stock price will go down. You borrow 100 shares of Company X from someone else and sell them for $10 each, making a total of $1,000. A few weeks later, the stock price drops to $8 per share, and you decide to buy back the 100 shares for a total of $800. You then return the shares to the original owner and keep the profit of $200. One benefit of short selling is that it allows traders to profit from a falling stock price. Short selling can also provide liquidity to the market by allowing traders to bet against overvalued stocks and keeping them in check. This can help prevent bubbles in the market. However, short selling is a risky strategy as it can lead to unlimited losses. If the stock price keeps rising instead of falling, the trader will have to buy back the shares at a higher price than what they sold them for. This can lead to significant losses. Additionally, short selling can be subject to regulatory restrictions, such as short sale bans during market crises. Short selling has been the subject of controversy in the past, especially during market crashes. Some critics argue that short selling can worsen market crashes by increasing volatility and panic. For example, during the 2008 financial crisis, some hedge funds were accused of using short selling to profit from the collapse of the housing market, leading to widespread public anger. If you are considering short selling, it's important to do your research and understand the risks involved. Short selling is not suitable for all investors and should only be done by experienced traders who can afford to take on the risks. Additionally, it's important to have a well-diversified portfolio to help minimize the impact of any potential losses. Before we end this video, let's take a look at some of the common misconceptions about short selling. One common misconception is that short selling is illegal or unethical. Short selling is a legal and legitimate investment strategy that is widely used in the stock market. Another misconception is that short selling is the same as market manipulation. While short selling can be used for nefarious purposes, such as spreading false rumors to drive down the stock price, this is illegal and is not a legitimate use of the strategy. Short selling is just one of many strategies used by traders in the stock market to make money. While it can be a risky strategy, it can also be a valuable tool for managing risk and maximizing profits. Remember, before you decide to short sell a stock, make sure you understand the risks involved and have a solid investment plan in place. Thank you for watching, and we hope you learned something new today.